Now we have the short put calendar spread. And the short put calendar spread is going to be very similar in methodology to the short call calendar spread, in that we are going to be expecting or wanting to see some of the very similar aspects of the call calendar spread. And in the short put calendar spread, the trader is looking for implied volatility or the vega to drop dramatically upon entering the strategy. Remember, when we're short something or short an option, we want to see volatility contract rather quickly. And we would like to see the underlying move up or down quickly. To create the short put calendar spread, you're going to buy one put in the near term option expiration, and you're going to sell one put in the more distant option expiration. Now keep in mind that we are going to generally create this strategy at the same time. You can click on it with your online trading platform that you are selecting a calendar spread, and it will implement it as a spread. So don't ever try to leg these. And generally we're going to create the strategy where one uses the same strike or a horizontal spread. But you can also use different strikes, which is the diagonal spread. And we will do that in different situations depending on how volatile the market is. So sometimes we would want to do it. And also remember, keep in mind, you would not want this to let the front month option expire before closing out the further duration, because with the short put calendar spread, you would be increasing your risk dramatically. The max profit is going to be the net premium received and occurs when the two options reach parity again. That said, the underlying rallies enough so that both options become worthless, or the underlying declines so that both options are deep in the money and trade at their intrinsic value. And remember, we're going to be implementing this strategy with the at the money strikes or just out of the money strikes, closest to the at the money. And the max loss is going to occur when the underlying remains steady. The max loss is the long put premium minus the cost of buying back the short put minus the net premium received. Remember, we have to say the cost of buying back the short put because we don't ever really know how vega has affected the premium in that long duration contract. But if you blow it, like I mentioned earlier, and you let the put expire, your loss is theoretically unlimited, or that it can go to zero. And the break-even is going to be the cost of closing the position when it's equal to the net premium received. Now remember, we're going to know what our net premium is when we enter into this contract, but we'll never really know exactly where the break-even is, because the break-even is going to fluctuate a little bit, because it's going to be cost of closing the position. It can kind of, cost of closing that position is going to kind of go up and down. And here is a graph of the short put calendar spread. The short put calendar spread, as you can see at the bottom there, I've created two separate. One looks like a legged calendar spread and the other one is a calendar spread. As I've mentioned several times, and I don't know if I can mention it enough, the rookie mistake is to leg into any type of spread or out of any type of spread. So I did this only for visual representation to show you that where you sell the August 60 put, now I couldn't get eBay trading at 61.5 right here, or right around 61.5. The closest option I could get was just out of the money with the puts at 60. So the net credit received is 60 cents. So this is going to get a little confusing because everything is 60. But the August, we sold the August 15 at a strike price of 60, and we received a credit of $2.01. And then we bought the July 15 60 puts, which is the closer duration, for $1.53. Now remember, whatever the name of the calendar is, short put calendar, it's because we're short the longer duration.